Hi everyone. This week we're going to be looking at Chapter 4, Problems P4-28 and Continuing Problems CP4-40. Both of them are fairly similar in nature, and what we're doing this week is we're concentrating and learning about the closing entries. So we're at the part of the accounting cycle where we have already done all of our journal entries throughout the period, usually about a year. And at the end of that period, we have done the adjusting entries, which we did last week. And now what we're doing this week is the closing entries. Closing entries are those entries where we close out what are called the temporary accounts. And those are the revenue, the expenses, and also the withdrawals. Those are temporary accounts because what happens at the end of the period is we need to basically close out the income statement so that the next period, the next year, we start off with a zero balance in the income statement. So we'll talk a little bit more about that, but let's take a look at this problem. In P4-28, in the textbook, we're given the adjusted trial balance. So again, we've done the adjusting entries, and now we have an adjusted trial balance as opposed to an unadjusted trial balance, which is before the adjusting entries. But in this case, we've done the adjusting entries, and we now have an adjusted trial balance. And really all you're doing is pulling the numbers from the adjusted trial balance over to these statements. So for instance, in requirement 1, we have the income statement, which is our revenue, our service revenue, and then all of our expenses. So you're just going to list, taking them from the adjusted trial balance that's in the textbook, that's in the problem, and you're going to list all of the service revenue and all of the expenses. You're going to add up the expenses, and then you're going to subtract the expenses from the revenue to get your net income, or in this case, it's going to be a net loss because our expenses were more than the revenue. So this particular year, Elmo Real Estate actually lost money. So now that we've done the income statement, then we are ready to do the statement of owner's equity. And the statement of owner's equity is simply going to take the capital from July 1, 2015, and you get this from the adjusted trial balance that's as of June 30th, 2016. So the capital that's listed as June 30th, 2016 would be the same as the capital that they're beginning the next month with, July 1st. Then if there's any owner contribution, you're going to list that there. If you do not see an owner contribution, then that would be 0. And then you're going to add or subtract your net loss for the year. Again, if it was a net income, you would be adding it, but in this case, it's a net loss, so you're going to be subtracting that from the equity, because if you lose money, you have to draw that out of the equity. You've lost equity in the business. And then you want to subtract owner withdrawal, and I'm going to emphasize that you're going to subtract the withdrawal. A lot of students make the mistake and they add the withdrawal, and you don't want to add a withdrawal. A withdrawal from equity reduces that equity. And then you're going to have the Elmo capital at the end of June 2016. Next step is to go to the balance sheet. And again, you're going to pull the numbers from the adjusted trial balance. You're going to pull all of the listed assets. Then you're going to do your current assets first. Then you're going to do your plant assets. Now, the thing I want to point out here is that you're going to list the value of the building in this cell in B13. Now here it says less accumulated depreciation building. It's important that you subtract the accumulated depreciation, because remember, depreciation reduces the value of the asset. So a lot of students will make the mistake of adding that number. You want to subtract accumulated depreciation because it reduces the value of the building. So you subtract the accumulated depreciation, put the new balance there. Land does not depreciate, so you're just going to put the value of the land, and then you're going to have your total plant assets. You add that to the total current assets to come up with your total assets. Then you're going to list all of your liabilities, your owner's equity, the capital as of the end of the period, and you'll have your total liabilities and owner's equity. Now you want to make sure that your total liabilities and owner's equity equals the total assets. If they do not, then you've made a mistake in copying over sum of the balances. So you want to go back if your balances do not equal and see where you're off. The next step is to do the closing entries. The closing entries are always the same. And I've listed the available accounts over here that you're going to use to create these 4 different entries. And again, they're always the same in the closing process. The first thing you want to do, we want to close out the temporary account called revenue, service revenue. We're going to close out the revenue to another temporary account called income summary. So if the service revenue will normally have a credit balance, in order to close it out, you want to debit that balance. So if whatever we have a credit balance in revenue, you want to debit the service revenue, and then you want to credit the income summary because you're moving the revenue, closing out the revenue into this temporary account called income summary. The next step is to close out all of your expenses. Now, expenses normally have a debit balance. So in order to close out the expenses, you're going to credit each of those expenses. And then you're going to close it out by debiting the income summary account. So again, you're going to be closing out the expense accounts by reversing them. Their debit balances, you would credit them in order to close them out, and you move them into the income summary account. So remember, your debits always must equal your credits. The third step is confusing to a lot of students because the third step, now we have the revenue in the income summary account and we have expenses in the income summary account. But now we're going to actually close out that income summary and we're going to move it to the capital account because it's important to bear in mind that whether you have a profit or a loss, it has to affect the equity. If you've made money, then you're going to be adding to the equity. You're going to be adding to the capital account. If you've lost money, then you're going to be reducing that capital account. So whether you have a debit or a credit balance in your income summary from doing the closeout of the revenue, the expenses, you want to then reverse that income summary, close out the income summary, and move it into capital. So whether you have a profit or a loss, you're going to be moving that profit or loss in this third entry to the capital account. And then the final closing entry is to close out the withdrawal account. So again, you want to do the opposite. If it's a credit balance, you're going to be debiting the owner's withdrawals. If it's a debit balance, you would credit it. And then you move it into, again, equity, because equity is going to be reduced by the withdrawals. Okay, so again, you're going to close out the withdrawal account and you're going to close that out to the capital account. Then in step 5, requirement 5, you're simply going to pull over all of the balances that have not been affected by closing entries. You're just going to pull the balance over from the adjusted trial balance into the particular account that's listed here. Now you'll notice that some of these will have a closing account. So you just take your closing entries and move those amounts that you had right over here, and you're going to be coming up with a final balance. Other than that, if it does not have a closing title here, you're just simply going to be pulling over the balance from the adjusted trial balance. So for instance, none of our closing entries affected cash. So we have a debit balance of cash for $4,900. So you're simply going to here put $4,900 and list it here again as $4,900. That's all you have to do on any account that's not affected by the closing entries. But again, you want to pull over your closing entries here, wherever you see closing. I hope that made sense the way I explained it. Then once you're done with all, and you get all of your balances for each of these accounts, you're then going to pull it over into what's called the post-closing trial balance. So up to this point, we have done an unadjusted trial balance. Then after we did the adjusting entries, we have an adjusted trial balance. Well, now after our closing entries, we're going to have a post-closing trial balance where we want to make sure that our debits equal our credits. Now you'll notice that the difference here is that we only have assets, liabilities, and owner's equity or capital. And the reason for that is because we have closed out the revenue accounts and the expense accounts. So all of those are gone because they've been zeroed out. So that's the difference with a post-closing trial balance from your unadjusted or your adjusted trial balance. The next problem is pretty similar, except for in the first requirement, you have a worksheet. Now this is a continuing problem, so this is the one that we've been doing throughout this course. So this first requirement is optional. You can fill this out, you don't have to. I don't take off any points if you don't, but it's a helpful tool just for you to kind of get a bearing as to where you're at. So based upon week 3's assignment, you're going to be putting in your adjusting entries. You had your unadjusted trial balance, so you just go back to the previous week, put in your adjusting entries here, put in the numbers for your adjusted trial balance, which would be the same as from week 3, and then you just move all of those particular balances over either to the income statement or to the balance sheet. And then from there, you can fill out the rest of these requirements. Again, you can skip requirement 1 and go right to here, but you're going to fill out your income statement, doing pretty much basically the same thing that we did in the first problem, but now we're not going to have a net loss, we're going to have a net income. There's going to be a profit this year. And then we go on filling out our statement of owner's equity. Again, remember, you want to subtract withdrawals from the balance. Withdrawals will always draw down the owner's equity. And then you fill out your balance sheet, remembering to subtract accumulated depreciation from both the equipment and the furniture. Then you're going to do the closing entries. Now they're going to be very similar to what we did in the first problem, except for in that third entry, instead of having a loss like we did, we're going to have a profit. So it's just going to look a little different in terms of whether you debit or credit the income summary account, but you're still moving that profit into the capital account. And then that fourth one, so the first step is to close out your revenue. Second step, close out your expenses. You're closing both the revenue and the expenses out to that income summary account. Then you close out the income summary to capital, so that would be the profit or the loss. And then the last step is to close out the withdrawals to equity, because equity will decrease the equity in the business. And then again, you're going to do the same thing you did in the first problem. You're going to fill out these T accounts and then move the balances over to the post-closing trial balance, remembering that revenue and expenses are gone because we've closed them out, as well as withdrawals are gone. Okay, I think that pretty much will explain it. If you have any questions, please don't hesitate to reach out to me. I'm available in the classroom Mondays through Friday from 12 to 8 p.m. Arizona time. Thanks so much. See you next week.